This is Steve Gelsi with MarketWatch, where we're talking about the use of benchmark indexes in the asset management business. With us are two experts on the topic. We've got John Jacobs. He is the Executive Vice President of the NASDAQ OMX Global Index Group. And we have Steve Cheng, who is a Senior VP, Global Head of Data Management Solutions at RIMES. Thanks for joining us, guys.
Thanks for having me.
So John, give us a little rundown of the asset management business in the last 10 years, the big challenges, major benchmarks that major events that we've had to deal with in this business.
Sure, and I'm glad I'll go a little beyond 10 years because, but if you think about it, what has the last 10, 12 years had for us? We started off with the 1990s with the run-up, and we had the culmination of the tech bubble in 1999 to 2000. Then we saw the market between that period of time. We saw the 2008 financial crisis. Now we're seeing the recovery, theoretically the recovery today. And every one of those is different. They're not all the same. If you look at back in 1999, the tech bubble was primarily in technology stocks. It was a sector. The stocks, the indexes that were more heavily weighted toward technology, they ran up more and they fell further. The ones that were more broad-based didn't. So not every asset manager, not every portfolio manager actually participated in that, to good or bad. And we saw it different. In 2008, in the financial crisis, there was no way to hide. That was broad-based. That was multi-sector, multi-asset class, multi-country. There was no place to hide, whether it was fixed income, equity, commodities. There was no place to go. And depending on how people use benchmarks and how people used indexing then, they either benefited or didn't benefit from that. So now we're in a recovery phase, and we're starting to see different demands from the marketplace on how to handle this particular market. So it's every one of these is we're learning lessons in every one, I think. So
there have been a lot of these benchmarks that have come up. Steve, we were talking earlier. There's literally hundreds of thousands of benchmarks out there. How did we get so many, and what kind of challenges does this pose to asset managers?
Okay, well, what we've seen recently is that there's been a great growth in a number of dimensions. The first is the increasing number of benchmark providers, both from emerging market exchanges and also from alternate asset classes. We're also finding a growth, as well as in the number of vendors, the number of benchmarks that they're providing. And kind of more importantly, we're seeing a lot of complexity in terms of customized benchmarks, blended benchmarks. And the demand for customized and blended benchmarks is driven by the very factors that John has just been talking about. The fact that investors now want to be able to consider active indexing as a part of their investment policy. And in order to be able to do that, you need customized indices. So what we're seeing is a lot of creativity in order to be able to give both transparency, but also to give investors more of a control over their own destinies.
So there are a lot of these benchmarks out there, as you said, and it helps people give more control of their destinies. You also did some independent research on the topic. RIMES engaged investment management consultant Invested to conduct independent research on this topic. What are your folks out there saying? What are folks out there in the industry saying about this?
Okay, we commissioned the research because we felt that asset management organizations were on the back foot concerning this set of data. Traditional market data like prices, exchange rates, corporate actions are all well understood. But what we're finding is that because benchmarks are the communication mechanism for stakeholders within industry to communicate to each other about their needs, requirements, and also for them to report back on how they're actually performing. This data set is now key, and we believe that this area was under-researched, so we thought it was important to actually get some better data about what was going on in the marketplace.
And John, what are you hearing from market makers and market participants on this topic of benchmarks? Are they confused? Are they intimidated? Are they happy about having these tools? What's going on?
Well, I think it's mixed. I think, and we do hear a lot, but I think it's mixed because in many ways the word benchmark implies a report card. They're going to be measured against something.
Right. I
think to pick up on Steve's theme, what we've seen is the growth of the need for active indexing and better benchmarks. In the old days, it was go long. And whether it was an active manager or an index fund, it was just picking which list of stocks to go long in. Those days are over. It's far more complicated today with multi-asset classes and it's a global economy for good and for bad. So what the indexers are trying to do is create far better benchmarks, far more customizable and flexible benchmarks so that as portfolio managers, as market participants, as traders, as all of those people out there are trying to manage risk, serve their customers, manage their portfolios, that they have the tools necessary to do that, and they're going to be judged on it. It's far more quantitative and disciplined than it was in the past. And so those benchmarks provide tools. RIMES Group adds on to that, and it's a far more quantitatively disciplined mathematical approach to investing than it ever was before, I think.
And yeah, one of the rising things that we're seeing too are 50-50 benchmarks. I guess that's 50% equities, 50% fixed income.
Right.
NASDAQ is launching one
Yes,
soon, and talk about that a little bit.
Yeah, it's one of the part of our suite of products that we
Sure.
offer as an indexer. And the idea here is, there's broad equity indexes. For example, you could take the NASDAQ all U.S. market and get the entire U.S. marketplace. And then there's the AGG for the aggregate bond index, and you could do that, and you could probably do 50-50 in that, each one of those indexes. But that's not the same thing as having a blended benchmark, which reduces your transaction costs as you manage to it, and actually can look into it and understand the risk returns and all the other factors involved. So the market's asked for better tools. So that better tools, in our opinion, means better benchmarks, and then better insight, better analytical tools on those benchmarks. So 50-50s is a first step, or just an additional step, and I think you'll see continuing more of these kind of benchmarks coming into the marketplace. Okay,
and Steve, more on that 50-50 theme. RIMES is a technology expert in the benchmark business. Any extra challenges that this might pose to players in the game here, or any other kind of issues that might surface?
Yes, definitely. Any innovation within the financial markets always imposes a cost on the business.
Sure.
And so one of the issues is that the new NASDAQ product is a good example of the innovation that's going on within the marketplace, but this layers a new set of costs on the asset managers. And our feeling at RIMES is that the managers are still kind of catching up with the new reality. They're going to have to get used to an environment where there are constantly new benchmarks, new customs and bends being created. And what we're seeing is that some asset managers are actually changing their benchmarks on a regular basis. It used to be once a year, and sometimes it's even quarterly. Now, we can debate separately whether that's a good thing or not, but the important thing to recognize is that this layers on a set of costs in addition to just the raw transaction costs of trading in and out of instruments, and this is something that managers have to be aware of if they're going to remain competitive in what's a very challenging environment.
I think a great point on that is that if you looked at an equity index or a bond index over time, you might be compelled to switch and change, exactly as Steve points out. But if you looked at a smarter benchmark over time, you could use a benchmark that requires less change over time because you're getting a better benchmark. And I think that's one of the things we're trying to point out, that there are better ways to handle this and serve your customers.
Okay, John Jacobs and Steve Cheng, thanks for talking to us about benchmarks. I'm sure it'll be very useful to folks in the business.
Thanks for having us.
This is Steve Gelsi in New York and the NASDAQ. Thanks for joining us.